Understanding market conditions is at the heart of every successful trading strategy. Today, we're joined by John Kicklighter, StoneX's global head of content, to explore the three main types of markets: trending, ranging, and volatile, and how recognizing these environments can transform a trader's performance. Hi, John. Welcome. Thank you for joining us. So let's start with market awareness. So you know how some traders just get it. They can just sense the market's tones right away. What are the first clues that you look for when trying to figure out what kind of market you're in?
So there's a number of measures that we look for, and generally what you're looking for in terms of the three market types is level of activity and level of conviction. And that can turn into directionality and level of market activity, if you want to boil it down, time being even. So range, breakout or volatile, and trend are the three ever-evolving fluid types of markets. And you can use a number of different tools to actually derive that. So I break it down in terms of activity and trend. So that's the easiest way of doing it. So if I want to see a market that is range bound, all right, so it's best to define the conditions, I think, a little bit of the three different types. A range-based market is one in which it holds to a consistent channel, two price levels, and it doesn't really move out of it. Okay. And as we move back and forth in that range, markets can be volatile, can bounce back and forth very rapidly, or it can do so very slowly. We've seen periods like this, like back in the summer of 2017, where volatility is really low and markets were very consistent. U.S. equity indices as a benchmark, while they were progressing, they were well within a definable range, not moving very fast or very far. Now, when we add volatility to that mix, and we still might have ranges, we get into a situation which can turn into breakouts. So a breakout is really defined as a very active market that breaks beyond a technical boundary or a established price boundary or level. And you need something of a range to define a breakout because you are surpassing that boundary. So it's the application of volatility to a range. Now, there's no guarantee that you're going to move from range to breakout, but the higher the volatility, the more likely it is to turn into a breakout. So that's why I like to look at the level of activity of the markets. And then we have a trend, and a trend is just one, it makes its own definition. You have a consistent directional movement. Now, trends can come both with high levels of volatility and low levels of volatility. We've seen slower trends or faster trends, but typically you want volatility to be middle of the road or lower, because if you have a very rapid trend, the likelihood that it's going to overextend itself and pull back is much higher. So that turns into a reversal situation, which is more of a volatile turn from a trend to a range, and where it ends up is what's going to establish that price boundary. So those three types of markets are really moving into each other. It's a range to a breakout to a trend, or it could also be a range to a breakout and then just turns into another range. But the ever-evolving movement between them is usually defined in terms of how much direction you have and how much volatility you have in the markets. And then you can establish what kind of market am I looking at, and that goes very far in determining what kind of strategy should I employ, because you definitely don't want to play a range trade when the markets are getting to be very volatile, because then you can you find yourself very quickly in a losing trade.
Therefore, do you think that some personalities are better suited for certain market types?
Yes, our predisposition or our risk tolerance will very significantly define how we're able to adapt to a market, whether we recognize the adaptations of the markets, or whether it's advisable or not to stay on the sidelines. For a lot of self-directed traders or individual investors, they simply are pursuing volatility, whether they recognize it or not. Now, that usually means they're looking for what are essentially breakout markets and fast trending markets. But breakouts don't happen often. Trends are more normal, But for the predisposition of the average retail trader, let's say, they're better equipped for ranging conditions. The reason being is a range has very definable levels typically. So I can look at a chart and say it's going to bounce between 190 and has been for a while. Volatility is relatively low, so let's say I don't think that it's going to have a high risk of breaching that range. But as it nears the boundaries, I can start formulating a trade approach around it. So for the average disposition of the retail trader, who usually doesn't like to hold a position for very long, so you want a range, otherwise you're going to be in it for an open-ended period, that's usually the approach, or a trend. For the long-only investor, which is not just a retail investor, it can also be a lot of the professionals out there. They can look for something along the lines of a trend. So in that you want a consistency, you want a lower volatility, you want the evidence of directionality, and that's usually better suited for their approach. Now, the question is, what do I do when I see a market that is not adaptable or not equivalent to my approach, my predisposition towards risk? We have to be able to identify these types of conditional changes, or if we're not even in the market and we're evaluating the market, we're analyzing it. If it does not fit our general disposition or our risk tolerance, we probably shouldn't enter, or we should exit if we are currently in it, or find a way out.
Well, you just answered my next question, which was how can traders find the right fit for themselves? But
Yeah, it's to really understand what kind of tolerance do I have.
yeah.
You should be able to say, and some people have to look at themselves honestly and earnestly, or understand what their needs are earnestly, and see what kind of conditions I should approach, and that should tell you what kind of position exposure you're looking for, whether it be hedging activity or outright exposure for trading or investing purposes. So you need to be able to identify what kind of tolerance I actually have, what's my personality actually adapted to, and what kind of time frame am I looking at. If you are looking for, let's say, a 500-point move, but this market, it might be trending and it only moves about a point a day, and I think I'm going to be out of the market, in and out of the market in a week, it's wholly unrealistic. So we have to look at what the markets have to offer us, what my expectations are, and how I approach the markets, and what risk tolerance I have. And you'll be able to very readily, I think, find what conditions are best suited for you, and then you can pursue those conditions and avoid them when the markets when they're not there.
And how do you stay aware when things are clearly changing? Are there any mental checklists or routines that you follow?
I like to keep a certain level of technical indicators on there, even if you're not a big technical analyst. I've been at this for a while, so I've run the gamut. I've run from purely technical analysis, getting into very complicated approaches to the ever-evolving combinations of price and time, all the way to just purely fundamental, looking at event risk or looking at themes. But I've landed on something I think that is a little bit more of a better balance. And I use the technicals to really give me a sanity check on the measurement of volatility and direction. And you look at something like a rate of change. It's very simplistic, but it's very accessible. And you can look at something like a volatility metric, like an average true range, which gives you a current measure of activity. And I use those two things. Those are very basic tools that you can say, I'm looking for a range, but I can see the rate of change is very strong, positive or negative. That means there's momentum there. It is not really abiding by a range. And if volatility is high, if there is a range, then I'm likely to break through it. So I use this combination of technical tools, again, very simple, because it can give you a easy and approachable way of doing this. Now you can get a lot more complicated than that. You can have a 50-point checklist to say what kind of market conditions I'm in, but it's not just being able to be aware of it, it's being reasonable with yourself and saying, I don't see this type of market according to my written definition of what a range, breakout, or trend is, and I should just stay away, where I should get out. And being able to do that, I think, is one of the biggest hurdles for many people.
So then walk me through what you do on a trading day. So how do you prep for your research, knowing that the market type could change on a dime?
So I will usually open up my charts. I like the technical analysis because I can,
After you've had your coffee, of
yeah, so, while I'm drinking my coffee, I
course.
think.
Okay.
But it's really, it's such a simple, easy way of seeing things because I can compare across markets very rapidly. Of course, I don't know a whole lot of the fundamentals, what the scheduled event risk is later, if there's an unfolding theme that I need to be aware of, but I can very rapidly see with basic charts, with those two indicators I mentioned, um, what kind of condition I generally have. And you can change it to the time frame I want. It could be a 15-minute chart, it can be a daily chart, it could be a weekly chart. And I can see over that time frame, am I generally looking at a range, breakout, or trend? If I have an existing exposure, and let's say it wasn't what I intended to get into, if I were getting into a range trade and I pull up my charts and I see that there's conditions that suggest I'm in a breakout or I'm in an evolving trend, I have to evaluate, is this the reason I got in? And if it's not, then I usually get out. If I'm looking for new opportunities, if I don't see a range, breakout, or trend, which is my preference,
Yeah.
then regardless of what the fundamentals or the other subsequent analytical techniques that I want to employ say, I don't have the foundation of what I'm looking for. Or if you want to get a little more complicated, I think over the years, if you're very honest with yourself and you can see how your propensity towards psychology, trading psychology evolves, if you're calm and collective enough and really self-reflected enough, you can actually establish strategies for range conditions, breakout conditions, and trend conditions. And you can just decide, I like this particular asset. What kind of conditions is it today? Well, this means I'm going to employ this strategy, which is appropriate for these conditions.
And last but not least, for any traders that are trying to get better at reading the market types, we've talked about your daily habits, so I'm not going to ask you again, but are there any mistakes that are worth leaning into? Is there any piece of advice that you can give them?
I am very big on retrospective. I like to look at my trades after they're done and see what did I do right, what did I do wrong. It's easy to actually highlight and review and really pick apart ones that go wrong. The worst thing you could do is have a trade go against you and really give it no attention, no heed, because you're not learning from those mistakes.
Yeah.
It might not be that you made a mistake. It might be that your strategy was employed with sound analysis. It just didn't play out as expected. Everything is a probability. Nothing is certain. So that is very fair. But if you do this retrospective and you see that I didn't really adapt to what was a shift from one of those market types to another, and I could have saved myself, let's say, pain through 3 additional days of losses, then that's a mistake that you can take forward and say, I need to either define my criteria a little bit better about evaluating this, or maybe I need to act a little bit better. Maybe I just need to change my strategy. Maybe I need to create a breakout strategy to complement my range-based strategy. So really reflecting upon those mistakes on losing trades in particular, it is also very easy for us not to review our winning trades. We are just riding a high and we move on to the next one. But in reality, you should also evaluate, what did I do wrong on this winning trade? You don't want to have to luck your way into trades, because that string is not going to last forever. And if you do not adapt to a bad strategy just because you were lucky, eventually the luck's going to run out.
John, thank you so much for sharing all your insights and for being here with us. And thank you for watching. For more financial content, don't forget to like and subscribe to our channel.